Anand Shah, head of PMS and AIF Investments at ICICI Prudential, with us in the studios. Anand, great having you. It's been a while. Thanks for joining in.
Pleasure, man. Good to have you.
Yeah. So, Anand, what's your sense? I mean, we've done a bit of a recovery job from those 23,500 levels, and off late, the market is, or rather, in the last 6, 7, 8 days, the market is shrugging off bad news, building or latching on to good news. How are you seeing the texture currently?
The way I see the T20 phase of the market is over. I think as we go forward, we had a very exciting 4 years. We made a very swift return because over and above alpha, you had a very strong beta. You had a 34% earnings growth rate. Markets have delivered that sort of return. I don't think that's sustainable. And to that extent, from here on, it will be more of a test match. People will make money. It's not that market will stop making money, but over a long period of time with its own ups and downs. Over a 5-year period, you will have down markets, you will have up markets, and then similarly within a month, you will have and there are factors, as you rightly said, GDP growth was one of the factors, but I think that got already factored in the earnings. If you see the September, both June quarter and the September quarter results were disappointing. People shrugged off the June quarter saying, look, it's one-off. But then it sustained in September. Consumer companies had a really tough, because they were sort of doing well post-election, saying, look, government will spend money, there will be revival in rural spending and rural consumption, and that didn't come through in September. So that led to the market correction. But having said that, look, market is down only 8 to 9% from its high. It's not that like it's corrected so much that it has become a value zone.
Not value as yet. You know, by the way, I don't know if we can, just before, I don't know if we can pull up the chart, but there is this wonderful chart given in the presentation that ICICI Prudential has made, wherein they show, when they talk about the periods of volatility, and I think maybe some, 104 times, if I'm not wrong, in the last so many years, the Sensex has had a corrective move of over 10%. There on your screen, all the blue bars, viewers, that you see are the number of times or instances wherein the index has corrected over 10% in a given calendar year or a period at one single point of time. So the market will not be bereft of very steep corrections. The interesting piece though, Agam, if you permit me just one more question.
Yeah, of course.
You were saying that we are still not at good valuations. Did I hear you right?
No, yeah, so obviously markets have been expensive, but then you had a very solid earnings growth rate. Last 4 years, we had 34% odd earnings growth rate. So those rich valuations are fine. But if you see June quarter and September quarter, we had only 3% year-on-year growth rates. Right. Just on that data of 104, 10% corrections, that's over a 34-year period. On an average, market used to correct 10% on an average 3 times a year. And we haven't seen a 10% correction since Russia-Ukraine, which is a June 22. This is the first 10% correction we saw since June 22. So I think market have a very strong domestic flows, which is good counterbalance to the FI inflows or outflows. Either ways, even when there will be a strong FI inflow, I should expect that the domestic investors or the domestic institutions would be on the selling side. And to that extent, good news, rightly so, that the volatility of markets is reducing, which is a very good news for richer valuations. But nevertheless, I think 10% correction is not a big deal when you look at the historic data.
Right. So Anand, it's interesting you talk about the Nifty looking at a 10% correction right now. The last time we spoke back in October, you had suggested that if you consider the Nifty 500, a majority of the stocks in there internally had corrected as much as 20% from their peaks. How does that picture look now? And what are the areas that are now starting to emerge in terms of gains?
Yeah, so when we looked at November end, where the Nifty is around 8.5% from its all-time high, we had 253 companies out of Nifty 500. So more than half of the market is actually down by more than 20% from their individual 52-week highs. Right. And around 90 plus, 93 odd companies down more than 30%. Right. So the message is that while on the broader numbers at the Nifty level, it doesn't look like it's corrected a lot. Right. I think internally the markets have corrected a lot. We had frothy valuations in some segments of the market or frothy expectations. To that extent, market is much better than where it was in June or prior to that, when we had huge expectations of 400 par and others. Right. And to that extent, I think Coming back to your point of is it investable, I think for the long-term investors, these are very healthy correction. I think this corrections is what make market good for the long-term investors, while obviously it's painful for the T20 traders.
Right. And what areas are you starting to see emerge from there? Are there new leaders at this point in time?
So I think banking remains, and within the banking there has been now we had seen corrections in PSU banks also. So I think both private and state-owned banks looks comfortable to me. I think the credit quality has been extremely good to that extent. The capital ratios, the net NPA ratios, everything is very good. Obviously, there is early signs of some stress, but I think they're still manageable. Any revival in the economy, and that is what will be the key thing over the next 2 quarters. In the second half, as consumption picks up, as capex picks up, we will see some bit of confidence in the private sector to do some capex. I think banks, obviously, we like. They have been sort of an underperformer for a while. Valuations are reasonable, growth expectations are reasonable, they can surpass that. And the credit quality is still benign, bearing few segments of the market. I think where we see risks emerging in the market, I think we are seeing extreme competition in the organized retailing.
Right.
There were the value retailers and then there were quick commerce retailers. What we are seeing, observing more recently, I think there's a blurring of the lines. The value retailers have to match the game on the quick commerce and deliver a better convenience to the customers. And the quick commerce guys will have to offer value. So we are seeing good times for the consumers, but it'll be, my take is we don't know where it will end, but till it ends, it will be painful for the investors.
Sure.
Yeah, that's interesting. In fact, a lot of new companies trying to enter into this quick commerce or food delivery, or not food delivery, but the Blinkit and the Instamart space, and therefore, will that cap the relative valuations of some of these businesses? Because we are now seeing that getting formed as a sector, right? There was Zomato, now there is Swiggy, Zepto at some point of time might list. So that internet space is alive and kicking, but is the retail or the delivery part of that business coming under a bit of threat because other business houses also want to make a entry here, and these are deep pocketed houses?
Indeed. So I think the 3 quick commerce guys have got capital now. Zepto, Swiggy, Zomato, all 3 have got capital. We are seeing even the other guys are deep pocketed, as rightly said, be it BB, be it DMart, be it Reliance and others. And to that extent, you're right. It will be good times for customers, I'm again repeating, because we'll get both convenience and value.
Agreed.
But yes, we will have to see who has got the better game. And to that extent, it will be a time before we'll know the winners. And to that extent, that's a wait and watch area.
Okay. A question that I have is on the energy sector or the power sector, actually, not quite oil and gas, but power. Stupendous rally over the last couple of years. They've taken a bit of a pause, but the plans, I mean, we were speaking to Inox Wind today, the plans for the FY 25, 26, 27, very, very strong. Suzlon has spoken like that. Some of the other power companies are talking that green energy, etc. Would the stock price gains, if you believe they will gain, match earnings growth, or do you believe there will be a period of stagnation because the valuations are extreme and then the gains start?
I think we had a very soft demand growth rate in electricity over a decade when a lot of stuff was getting manufactured in China and imported. I think that has changed, and that led to revival in the power stocks in the last 3 to 4 years. I think what's happening in power is transition. So I think very clearly we have moved forward, transitioning from coal-based power generation to the renewables. And to that extent, if you see very clearly there's a shift, both from the incumbents as well as new players who are investing more in solar. I think lower solar prices, lower battery prices, they have made it that much more easier to provide, if not round the clock, but at least through the solar hours and through the peak hours, you can provide through a backup battery. So I think that makes solar that much more attractive. It's becoming more competitive vis-a-vis coal-based power also. And to that extent, the capital goods companies, the providers of those equipments, there also we will clearly see the shift from the beneficiaries moving from coal-based TB, the turbine, the boilers to the wind and the solar.
Okay.
Right. Anand, in terms of opportunities in the markets right now, and I'm talking it from a portfolio construction point of view, at this point in time, do you feel that a portfolio of around 35, 40 stocks would now start looking at a portfolio of just about 20, 25 odd stocks? Or do you see that there are still plenty of opportunities and that portfolio likely could stay at around 35 stocks?
I think the opportunities, as I said, is now broader.
Okay.
Look, prior to 2020, we had a very narrow rally. You had only set of companies which are doing well. The rest of the economy was to large extent struggling.
Yeah.
And that's broadened over the last 4 years. Having said that, there was a value in manufacturing, there was a value in cap goods, there was a value in PSU banks and corporate banks in 2020. That also doesn't exist anymore.
Yeah.
So now the market is more balanced. We are going more bottom up. We are finding ideas in pharmaceuticals, we are finding ideas in IT and consumers also, which we had sort of not invested over the last 2 to 3 years.
Right.
So now it's more bottom up than top down. We have a economy is in a good shape. We are all set to do well as the global economy also stabilizes, especially China. And in that context, I think the number of stocks can be higher rather than lower, given the opportunity is more broad-based.
Right. It's interesting that you spoke about pharma specifically and that you're saying that you're looking here in this area. Are there sub-segments here in the healthcare space? Is it just pharma? Is it diagnostics? Are you looking at hospitals? How are you placing your bets here?
Indeed. So I think in India, pharmaceuticals, each company is unique, and to that extent, you have to do a lot of bottom-up.
Yeah.
But yes, even retailing, the pharmaceutical retailing will become an interesting space. Diagnostics, as you rightly said, and hospitals. They all, again, as I said, they all discovered.
Yeah.
It's not that things are undiscovered.
Sure.
Whatever needed to be discovered broadly in the market over the last 4 years have been discovered. And to that extent, it's much more hard work from here on.
Yeah.
In each sector, forget pharma, in each sector to find winners. And at the same time, we'll have losers in each one of them.
Right.
So I think it's much more harder. Beta is obviously will be much lower than what we have seen in last 4 years.
Right.
Alpha is also going to become more difficult.
But sorry, just if you have 30 more seconds, somehow everybody seems to be very constructive on the CDMO part of the pharmaceutical space. Are you as constructive or not?
No, again, as I said, in each sub-segment
CDMO
also we will
you
have to
individual names.
Individual names.
Very bottom up.
Yes.
But as a theme, is it looking okay or is it under question?
Of course. It's look, that's a big opportunity, and even in terms of China Plus One also, that's an opportunity because it's a very large market there, and we are very small in compared to that. And to that extent, some of that shift can also happen.
Great. And always a pleasure talking to you. Thanks for joining in and giving us that perspective.
My pleasure.
Yep. And viewers, keep in mind that one thing, 10%, over 10% correction has happened so many times, so don't get too perturbed with that.